when the predictions are saying things are going to get worse, those are usually statistically, when those best days occur.
You need to make two decisions, two right decisions for it to work
Right.
out properly.
Yep.
When to get out, and then when do you get back in after you're out?
You're listening to Retirement Straight Talk with Paul and William, a father and son team helping you tackle financial planning challenges and real world decisions that matter most. Each episode, we'll share straightforward advice and proven strategies to help you build your dream retirement.
All right, welcome back to Retirement Straight Talk. I'm William Barreca, financial planner at West and Well Planning, and I'm joined by my co-host and dad, Paul Barreca. How are you doing today, Dad?
I am great, and hello, everyone. Welcome back. Got a great show for everyone today.
Yeah, I mean, so today's episode, it's all about setting the record straight on some of the most common and also costly investment myths. And these are things that we hear all the time, Dad, but they're extremely consequential. These are myths that will quietly hurt real people and their retirement plans. So we're going to tackle 13 of them and going to leave you with simple, practical ideas that you can actually use. And Paul, like I said, I feel like every single one of these that we're going to talk about is things that we've heard from clients, family members, or read online as we're scrolling there. So we're tackling 13 of them, and we're going to leave you with really just simple, practical ideas that you can actually use. And this is really important, Dad, because again, every one of these ideas or myths are things that we've heard ourselves from clients, from family members, or just even scrolling online ourselves. So today we're going to cover the first 7 of them. This is part 1 of a special 2-part series. And then look out for the next episode in 2 weeks where we'll be covering the last 6 of them.
Yeah. One of the things that I've noticed, William, is that, and I wrote a blog on this, I don't know, several months ago. The myths are that feel true because they're so often repeated. And there's really two kinds of knowledge as I see it. There's compounding knowledge and cyclical knowledge. Let just, 'cause I think this is important. Compounding knowledge are things like science, medicine. So, one generation, you learn something about medicine, and then the next generation builds on that to add. But there's another way of looking at knowledge, and that's cyclical, and that's more like investments. In other words, what we find with cyclical knowledge, we don't really learn it. We have to go through it and make the same mistakes. And we've been making the same investment mistakes for 100 years. And it seems like we don't really learn about how not to do these things. It's almost like personal relationships and marriage. I mean, divorce rates are at an all-time high. We've had hundreds of years how to be spouses, still need to go through these mistakes to really learn them. So just because something is said doesn't mean it's not true or doesn't mean it's true. And what we find, research into fin advisors, the people on social media, they find that and this is true with the regular media, the loudest and most confident people espousing financial advice tend to be the loudest, and they tend to provide statistically the worst advice. A recent study shows that only about 30% of fin advisors actually add value. The other almost 70, more than 70% either provide no value or negative value. And I guess I always go back to our friend Jim Cramer, who has been on TV for 20 years, earns a lot of money. A recent study done over a 5-year period for his recommended, what's his program? Mad Money, right? Is that
Yes.
right, Will? Mad Money. A study was done over every recommendation that he made over a 5-year period. And I think it was one of the newspapers in the UK that says, if you would have followed every one of his recommendations, you would have earned 6% less than the S&P 500. I mean, we see lately, I remember 3, 4 years ago on social media, there was all these advertisements for real estate promoting 15, 20, 25% returns without people realizing these were purely speculation. I'm guessing people who put money into this stuff didn't do that well. So just because something is the flavor of the day doesn't make it good advice. Just because it's something that is mentioned time and time again doesn't necessarily mean that's good advice. And a lot of this is not harmless. So if you believe in them, it could lead to poor decisions and really make a mess of your portfolio.
We're gonna break down each one of them, and then more importantly as well, we're gonna back it up with data. This is all from some great visual research from YCharts, which is the investment research company. So we're going to dive into again, everyone, the first seven of the common investment myths today. And we're going to break down each one with real data. Again, there's lots of myths out there that aren't backed up by true facts. Thanks to our friends at YCharts, we have real data and facts to back up everything we're going to say today. It's a great investment research company. And a quick reminder for our audio listeners, we're going to link to the resources in the show notes, and you can view all the charts that we reference by watching this episode's video on our YouTube channel, which is at West End Wealth Planning. So if you want to dive deeper after the episode, we've got you covered. Now, before we dive in, just a quick reminder and something new we're offering here at West End Wealth Planning. If you're already retired or are over the age of 50 now and starting to think about what your retirement might look like, our team is here to help. We're offering a free retirement assessment. So if you don't have a clear retirement roadmap, this is exactly what this assessment will do. Book a call using the link in our show notes. Okay, so let's start with myth number one, Dad, which is timing the market is essential for good returns. And I know we know this. This is one of the most persistent myths out there, and it's
Oh, yeah.
incredibly damaging. And it's tempting. I get it. It's tempting to think that you can jump in and out of the market at the perfect time, but that strategy almost never works, does it, Dad?
Oh, I guess I always like to say to be investing is very counterintuitive. Oftentimes, a lot of times, what you think you should do is often the exact opposite of what you should do. Just think of George Costanza, those Seinfeld fans. Doing the exact opposite is often the exact right thing to do. And I can understand, we're all human. I mean, this will never end because we're human. I'll give you an example. We sit down often with clients and we go through investments and how there's volatility and how the portfolio could, on a bad year, could drop X percent, whatever. And the clients say, yes, I understand that. And we're going to stay the course. But then when it happens, it's quite common. Clients will say, okay, what do we do now? Things are going down. What do we do? Because we're human. And if you look, for example, if you look at YCharts that William recommended there, over a 25-year period, if you miss the best 10 days, your potential return would drop, I believe, over a 25-year period, down from just under 8% to just over 4%. Well, that's a massive loss, just missing the 10 best days.
Dad, I
And
think
here's another comment.
I don't recall the exact number, but everyone will remember back in April when there's all that market volatility because of the news about the
Oh, yeah.
tariffs and everything, and markets declined double digits that month. But just as it almost always goes, when people least expected it, right in all the middle of that volatility, there was a really big day for the markets. I think it was up 3+%. And so that's the kind of days where if you miss those because you're scared about what's going on in the market, and if you miss that, that'll cost you big over the long term.
And the other thing is, people don't understand when those best days occur. If you look, the majority of those big days occur during a bear market and during a recession. This is factually backed up. The majority of those great days, and we've had days in the extreme where they've been up 9% in one day. Thinking back to the COVID, I think on March 24th of 2020, I believe markets went up 9% one day. And that's when the news and the media headlines are the worst, when the predictions are saying things are gonna get worse, those are usually when statistically, when those best days occur. So again, counterintuitive, think George Costanza, and you're probably gonna do better with your portfolio.
Yeah, and what a lot of people as well, Dad, maybe don't really realize when they think about market timing is that you need to make 2 decisions, 2 right decisions for it to work
Right.
out properly.
Yep.
When to get out, and then when do you get back in after you're out? And getting out is the easy part, isn't it, Dad? It's easy, again, go back to April this year when markets were down double digits. It's easy just to
Sure.
say, I'm gonna sell everything. Let me go to cash. Cash feels really comfortable at a time like that. But then how do you
That's
get
right.
back in? Like, when the markets are going up, you tell yourself, "Oh, I need to wait for another correction to put my money to work." And then when markets are down, again, it's easy to say, that when the markets are going down, that's the last time you want to invest because you just feel like, "Okay, things are just gonna keep going down lower. If I wait even longer, I can buy at a lower price."
But if you wait till things go down lower, the media headlines get worse and worse and worse, making you feel like, "Nope, not the good time now. I'm not putting my money in the market now." That's when you
That's
miss
exactly it,
the
Dad, and,
important thing to do.
people get paralyzed by this. I think back, this always sticks in my mind. I remember we spoke to a prospective client in, I think, the fall of 2020. So a quick little history lesson for for our listeners out there. That was the COVID year. Markets went down huge
Mm.
in March of that year. I think they were down nearly 30% depending on what exact market it is. And then there was a quick rebound that no one expected. Now this person that we were speaking to got out of the market during March of that year and missed the rebound. And we were talking to that person and they were all in cash. Unfortunately, they'd cost themselves hundreds of thousands of dollars by doing this. And they were like, I don't know what to do. They said, I feel paralyzed. I know that I made a mistake, but I
Yep,
don't know what
yep.
to do next. I feel scared putting my money back in the markets because I'm worried markets have done so well recently that they're gonna go down again. So that's the type of things that can happen. Just there's a saying I like to reference a lot that just stay in your seat and you'll capture what the markets return to you.
Yeah, who was it, Oak Tree Capital? Who's the oh, geez, I keep forgetting his name.
Howard
Well,
Marks.
you know the fellow. He's like a Howard Marks. One of his great sayings that I really like, he says, "Look, when you think you wanna do" and I'm paraphrasing this, obviously. "When you think you wanna do something smart, the best thing is not to do something smart or try and do something smart." I'm paraphrasing. I didn't get it right, but that's the
Yeah.
essential point of it.
All right, now let's jump in now to myth number 2, Dad, which is that markets have become more volatile over time and they're too risky. And I don't know who better to ask than you, Dad. You've got 35 years of experience. Are markets more volatile than they used to be?
Yeah, I've been through gosh, I've been through everything. I've been through what, Y2K, .com, financial crisis, anyway. Um, well, that's the interesting thing. Here's what you wanna look at. You could pick any day going back 50 years, I don't care, any day. Go onto the web, pick any newspaper, go to the business section, the investment section. You will find someone saying markets are volatile. I don't care when it is, if it's in a big bull market, a big bear market, there's always someone telling you that markets are volatile. Why are they saying that? Because markets are always volatile. That's the nature. Waiting for them to be not volatile, that's like going to a beach resort in the Caribbean and looking out on the ocean going, "Oh gosh, there's waves out there today. We better not go. We better wait till the water is absolutely crystal clear with no waves." It's not the nature of the beast. They will always be volatile, always. So, I mean, if you look at some of the most volatile periods, actually, there is no evidence to suggest that volatility has increased either in the last few decades. Matter of fact, why the YCharts, the things we talked about before, shows that the number of 1% plus day movements in the S&P 500 hasn't increased over time in any meaningful way. I mean, these are the facts. And some of the most volatile periods, like the early 2000s, the 2008 financial crisis, hey, those are decades away. My gosh, I think I'm making myself old. So again, things are always volatile, and again, we often hear from people, from clients, markets are volatile now. I mean, I'm just listening to Warren Buffett's book, Snowball, and they talk about how real investors love volatility. They love it because that's the time they see the opportunities. So again, George Costanza, do the opposite of what you often think you should do. Markets are not volatile. The fact is they're always volatile.
Yeah, and I think a couple things there, Dad. The first is that, to your point, and the data again backs us up from YCharts, volatility, if you look at it, if you look at the hard facts, it actually hasn't increased over time. But what has increased is the frequency and speed of news. So not the actual volatility, but just
Yeah.
all the information that we're overwhelmed with on a daily basis. So it just might feel more volatile, even though if you look at the actual numbers, it's not more volatile than it was historically. And
Yeah, just we're getting fed, media news about
yep,
volatility because how many different news channels and investment channels? I don't know, it seems like there's hundreds. They gotta fill the airtime with
yeah.
something.
And I mean, the second thing there too is that I think people need to make the proper distinction between volatility and risk, because volatility is often misunderstood as risk, and they aren't
Great
the
point.
same thing at all. Like volatility is temporary, short-term ups and downs, and risk to me is a permanent loss of capital. And of course, the volatility, it's uncomfortable, but it's ultimately the price you pay for the higher expected long-term returns of owning stocks versus just owning cash. And Dad, I know you like to say this a lot. Everyone would love the high return investment that never goes down. Unfortunately, it doesn't exist, does it?
No, it doesn't exist, and if you see this happens, if you see someone promising that, I'd be very, very
Yep.
careful of that because usually it doesn't
Now
work.
it's two before we move on, two really simple things you can do to not get swayed too much by volatility. Number one, just don't get obsessed by what's going on in the news. Like you said, Dad, there's always going to be a reason to be fearful. Just try and tune it out.
Yep.
And also don't check your portfolio too often. If you have a good solid investment portfolio, there's nothing to be gained by checking it every day, every week. Just if you don't check it, you're less likely to get swayed by what's going on inside.
Yeah. Well, again, we always go back to Buffett because he's such a smart guy. Your portfolio is like a bar of soap, according to Buffett. The more you handle it, the smaller it gets. There's a lot of truth in
Yep.
that.
Now, myth number three, and it kind of builds off of number two, but it's now is the wrong time to invest. Um,
Oh, yeah.
so why don't you go into that one a little bit, Dad?
Oh, gosh. I went back to, I don't have the figures right in front of me. I correct a study done a while ago over a 25-year period, and it compared an investor putting in a certain amount of money every year, and they compared either if they were perfect market timers. In other words, they picked the lowest point every single year to put their money in. The second comparable was putting it in at January 1 of every year. And then another comparable was being the worst market timer. So picking the absolute highest price every single year. And the interesting thing, at the end of the day, there was maybe about a 10, after 25 years, there's about a 10% difference in portfolio values. Now, I'm guessing a lot of people out there would think it'd be much better. In other words, there wasn't much different over a long period by being a perfect market timer, picking the exact lowest price every year and picking the exact worst time every year. There wasn't much difference. That's the long-term outlook. Even Buffett, when the financial crisis hit, he bought back in, put I think $26 billion into the market around the 26th of September, 4 months before, 5 months before the bottom. Markets continued to drop on the money he put in, but several years later, hey, he did very
Dad, I got a great example for you and our listeners just from this year. Again, let's go back to March and April this year with all the tariff volatility. If you'd invest in just a simple, broad global market stock portfolio in March 2025, right before the volatility started around the tariffs, you would have declined by about 15% or so by mid-April or so. So, you didn't time the market great at all. But if you just stuck with it, by now, at the time we're recording this, you'd be positive plus 15% approximately on the year. So again, to your point, you don't have to be the perfect market timer. You can even be a really bad market timer, and the markets will still do well for you.
And I think a lot of this, Will, is are you a real investor? And a real investor is long term. People often look at things, oh, I've lost money or my portfolio's dropped over the last 3 months or 6 months. If you're a real investor, an investment long term is 5, 8 years plus. If you're looking 6 months or a year, you're speculating. And that's a completely different way of looking. If you're speculating, that's going to happen. If you're an investor, what happens over 3 months, 6 months shouldn't make a difference to you.
Okay, now let's look at myth number 4, uh, which is sell in May and go away.
Go away. Well, this is one of the interesting myths that you hear every year because markets tend historically to do better in certain months, and they tend not to do quite as well in the summer as they do in the rest of the year. But if you look at statistically, you find that on average, every single year in the summer has produced positive numbers, except September, where I believe, I don't have it right in front of me, I believe the average return in September is minus about a 0.5% in 1 month. So if you follow that data, and of 6 months in summer, 5 average have positive returns. If you sell and go away in May and come back in the fall, you're gonna not do well because you've missed those positive returns 5 months out of 6. It's just a cliche. I don't know where it started, but if you look at the data, if you look at the facts, doesn't hold up at all.
Yeah, absolutely. Okay, now myth number 5, and this is definitely one I've heard frequently, more so in volatile periods, but in all time periods as well.
Yeah, yeah.
Holding cash is better than investing. So, I mean, so far today we've spoken a lot about market timing and just all the emotions around the markets being too risky, and some investors just saying, I'll just sit in cash until things feel safer, or just I'll sit in cash for forever just because I don't believe in stocks."
Well, it's interesting. We've had a couple of people, a couple of clients during really bad periods say, I want to stop the bleeding. I want to wait, as you mentioned, till things feel safer. Think about that for a minute. What does that mean? I want to wait until until the volatility drops. I want to wait till things look more positive. Well, when do things look more positive? They look more positive and they make you feel things are more positive when the media headlines are good. When the media headlines say, hey, market's going up, everything's great. Well, that only happens months and months into the recovery. In other words, if you wait until that time, you're going to miss many, many, many good months. It's again counterintuitive to what you think you should do. I go back, think of our friend George Costanza. Don't do what you think you should do often.
Yeah, I mean,
Yeah, it feels safe, but it's the
a,
wrong
a
thing.
perfect example, Dad, of this was in 2022. And to refresh everyone's memories, 2022 was a terrible year for the markets. Even, bond and stock markets were all down double digits that year.
Yeah.
And at the time, they'd hiked in the interest rates were pretty high in order to combat the inflation at the time. And you could get GICs at that time for around 5% or so. So by far the most common question we got that year, Dad, was, why not just buy a GIC? People would say I can get 5% risk free, stocks and bonds. I don't like what's going on in there at the time. But why bother with this? And well, the reason why is because people who stuck with a stock bond portfolio have had nearly double digit returns every year since then. And those GICs, they aren't yielding 5% anymore. Now you're getting maybe, 2 to 3% on a GIC. And that's sort of the long-term costly mistakes that can cost you, again, hundreds of thousands, even millions of dollars in your portfolio if you'd went to GICs when it felt safe, but it really wasn't.
Yeah, again, what's your objective? If you're a long-term investor, yeah, getting 5%, again, as you mentioned, if you got that 5%, you miss years of double-digit returns, and that doesn't take into account the extra tax if you're in a non-registered portfolio. Government that slice away a huge chunk of that 5%. After inflation and taxes, you probably earn nothing, maybe even negative returns. Again, when these things happen, look at the big picture. Are you a long-term investor, or do you if you need that money in the next few years, you shouldn't be investing it anyway. If you need money in 2, 3, 4, 5 years, you should be very, very conservative. But if you're a long-term investor for retirement and so forth, it doesn't make any sense to do that. It's almost in most cases, the great majority of cases, it's gonna cost you money.
Myth number 6, Dad. Uh, I hear this one online quite a bit. I don't know where this one came from either. But it's investing is like gambling.
Well, that's kind of funny. If you look at the potential returns in a casino, the return on every single game you play is less than 50%. The casino always takes more than half. That's their profit. So you've got less than a 50% chance of making money in a casino. Now, compare that to the investment market. In Canada, a balanced portfolio of about 60% stocks, 40% uh, uh, bonds or fixed income has never, I can underword never, lost money over a 10-year rolling period. By the way, rolling period means you could take any day out of the year, start from there, 10-year forward, it's never lost money. Compared to never lost money to going to the casino, the comparison is completely flawed and it's completely
Investing,
ridiculous.
it's the
Doesn't make
complete
any sense.
opposite of a casino. Like, again, to your point, at a casino, you can get hot for a night and win big, but the casino wants you to
Oh, yeah.
stay there longer because the longer you're there, the more the odds go in the favor of the house. And again,
Yeah.
in investing, it's the complete opposite. You can have a really bad day, month, even a year, but the longer you stay invested, the more the odds go in your favor. So I don't know where this myth
Yeah.
came from. It's people who I think don't have quite a clear understanding on how investing works.
Well, I mean, it's not uncommon. We've heard people come to us who they say things like, oh, I don't want to invest because my dad invested, I don't know, 10, 20 years ago and they lost money. And I go, well, tell me about it. And they'll tell me something. Well, they bought a mutual fund or something and then it went down and they sold it. Well, of course, because that's not how you invest. And I suspect that many of these people, that selling was done over a very short period. You can't expect to put money in the markets and it to always to go up. It's not going to happen. So again, gambling, the markets are the exact opposite, as you mentioned, of going to the casino.
Yeah, I think that's a wrap today, Dad, on part one of our rundown of 13 of the most common investing myths. Now, before we go, let's just do a quick recap and on some of the big takeaways from today's episode.
Yep.
One, trying to time the market rarely works. Just stay in your seat. It's way more effective long term for you. Next is that holding cash can feel really safe in the moment, but it's counterintuitive. And that holding cash, if you're a long term investor, can actually be incredibly risky. Next is that stocks have historically outperformed over time despite any short term volatility. And just last but not least, investing, it's about discipline and strategy, not gambling or investing. Nothing like a casino. Okay, so I hope everyone enjoyed that. Next time, we're going to dig into the second half, which includes myths around diversification, risk, and some of the most misunderstood parts about portfolio strategy. So make sure you tune in for that one. Hopefully, we've helped challenge a few of the assumptions and reinforce that staying the course usually wins out over chasing headlines. And also, hopefully, we've helped reinforce as well. There's a lot of misinformation on the internet, not based in facts. So anything around this, make sure any decisions you make are based in hard facts, not just myths.
And by the way, everyone, I want to remind you if you found today's episode interesting, our our free report is available to you, and it's called How to Build Your Dream Retirement and Avoid the 7 Big Mistakes that can help derail it. Hey, this is packed with information. And again, the main thing here is to build a successful future. The main thing is to avoid mistakes. And this really goes into it deeply. So you can get the information on that report in the show notes below.
Okay, thanks, Dad. Don't forget as well, if you found this helpful, be sure to like, follow, and subscribe to Retirement Straight Talk on YouTube, Apple Podcasts, Spotify, or wherever it is you get your podcast. And also just leave a review for the show as well. It really helps others find the show and join in on the conversation. So again, that's a wrap on today's episode. Thanks again for joining, everyone, and be sure to check in for part 2 in 2 weeks.
The views and opinions expressed in this video may not necessarily reflect those of IPC Securities Corporation. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions.